Our next guest says that there are great opportunities to make you some cash. You just have to look for them under the radar. He is James Frischling, the co-founder and president of the New Oak Capital, which has in excess of $100 billion in assets under advisement. Okay, so you've definitely not been right. I mean, you are definitely right, I think, in all of this. I mean,
I'm not correct.
Exactly. You're making money in this market. How?
We think the beta trade has taken place, and what we're trying to advise our clients to look for is more of those idiosyncratic risks. Where is there trouble? There's trouble in the commercial real estate market, but there are still opportunities to dig into some of these debt tranches, find value. You have to do your homework. This is not going to be an easy trade. This is going to be a grind. But we like to
back up for a second. Sure. You said the beta trade, because some of our viewers aren't quite familiar. How do you perceive the so-called beta trade?
A lot of the, it was almost, I don't use a bad word, but I'll certainly say a lot of the most troubled companies, troubled stocks, are the ones that have outperformed in this recent rally. The small caps, the highly levered institutions are the ones that actually have bounced back. So we actually feel there's an opportunity to, first of all, rotate out of some of those names, if I were making an equity recommendation, and into more staples, more franchises, more dividend-paying types of stocks. And on the debt side, where New Oak Capital focuses, we're looking for yield plays. Where can you pick up a steady stream, a reasonably high coupon, but understanding your risk?
And one of those areas, you say, as you mentioned, commercial real estate, but the debt part of that, how does an average investor play the debt part of commercial real estate?
Again, at New Oak, we are very focused on institutional plays and really for institutional investors. But there are some opportunities, I guess, or ways to play this through the retail sector. In terms of our overall mortgage and real estate strategy, a way to play this as a retail investor could be through mortgage REITs. MFA, for example, and I don't follow that and we don't own it, but there's an opportunity to look at a real estate opportunity. In the financial space, certainly the big boys have had their rally. We like, or at least recommending some ideas in the off-the-run or maybe that next tier down. And a retail way of playing that could be through the KBW Regional Bank Index. But again, we're looking at more specific opportunities to deploy capital in these types of banks if we can find them.
Off-the-run banks, define that.
There's going to be a consolidation in the banking industry.
It already is,
and it already is.
Sure.
So we do feel that there are ideas, and again, we may in fact be looking at some of these things, but there needs to be community banks. There needs to be, and in fact, I think the FDIC would call it community continuity. Who are the banks that are going to be serving the community, keeping the windows open? And again, it's not going to always be the usual suspects. So we think there's opportunities to find those types of institutions that may not have been too beaten up and actually help them advance their business model.
Well, as we know from the Fed today, money is still cheap to borrow. The Fed leaving rates unchanged again, but sounding more confident about the economy, saying the job market and consumer spending are improving. I think they even said that housing sales are edging up. The word they used was edging. So why wait to raise rates? We bring in the team here. Adam, I mean, you have to look at the downgrade of Spanish debt today, Portugal and Greece yesterday. But why is that an effect here?
Well, I think it's in effect because they have a big contradiction in the opening paragraph of the statement. After saying the economy is getting better, they say, well, bank lending continues to contract. That's a problem for small business. They go on to say that economic recovery is likely to be moderate with a gradual return to higher levels of resource utilization in the context of price stability. What they're saying there is labor isn't coming back, and as far as price stability, there's no inflation. So someone needs to do some splaining, Lucy. The economy's not getting better if banks aren't lending and if you're not going to be hiring people.
Okay, Robert Gray, then do you keep rates at the same rate for now instead of moving higher like Australia and Canada?
Yeah, and that's absolutely what they're doing. And, you know, in talking to economists and investors who are watching this, you know, closely like a hawk, as we all are, they're really looking for them to telegraph it well in advance. So clearly not ready to do that. Adam, talking about the lack of bank lending, we saw it tick up for a couple of weeks, but we saw it trend back lower in the past week, the Fed reporting, you know, total bank lending. So they really want to do what they can to keep at least short-term rates lower since they've exited the mortgage-backed security market, Liz. They want to try and, you know, get money flowing back into the economy before they start to raise those rates up.
Jim, though, you do run the risk of inflating another bubble when you keep rates too low for too long. Are you worried about that?
Well, I think the indications are that inflation remains subdued. But I think it's really the headlines and how many negative headlines are there going to be out there. You've got Greece, and today you have Spain, and obviously yesterday Portugal. You have Wall Street under scrutiny.
So is it safer to keep these rates low?
Keep the rates low, and as the Fed would say, keep the punch bowl at the party. And I think the punch bowl has been pretty spiked, and they're going to keep it there because the fact is earnings are in U.S. corporates are very strong, but all the other headlines, including some of the folks, the other participants just mentioned, unemployment are going to remain high. Housing remains very difficult. So I think the rates have to stay where they are.
Well, we've gotten back some of the losses yesterday. We're up about... Okay, thank you very much. S&P downgrading Spain, as we mentioned today, after downgrading Portugal yesterday, and of course, also downgraded Greece to junk status. I asked French finance minister in advance of all of this, Christine Lagarde, about whether Greece could actually eventually have to default on its debt. Default is a dirty word, but, you know, I had to ask her. That's what she said. There are naysayers out there regarding this Greek situation who say that the debt is so overwhelming that at some point they will have to, whatever you want to call it, reschedule the debt, which is frankly a very polite way of saying default, that Greece will eventually default on the debt.
No. I mean, the Eurogroup members are very determined. The IMF is on the same page. This is off the table. Restructuring is off the table. Simple as that.
Until it isn't? I don't know. Is it really that simple, or is this a turning point for the global economy? We bring back the team, Robert Gray.
Liz, if it was that simple, it'd already be done, right? I mean, she makes it sound simple, and ultimately, most traders, investors I've been speaking to have been betting it won't happen. They will do some kind of, they will be able to pay in some form or another. The question is, how are they going to restructure? And Germany really holding their feet to the fire right now before signing off on anything. And so we're going to see who blinks first. Is it going to be the investor side and the banks, the German and French banks, applying pressure on their governments, or is it going to be the Greek government?
Jim Frischland, what do you think? I mean, you look at how difficult the situation is in Greece right now.
It is very difficult, but and it's not simple. But it's not going to happen. There's not going to be default.
Why?
At the end of the day, I think the European Union and the IMF have to get together and take on the difficult task. It's not going to be politically favorable. It's actually going to be very politically different. I think Chancellor Merkel is proving that. However, the number, albeit large, is manageable. And Europe has the fiscal capacity not only to solve the crisis or solve the debt issues of Greece, but to then roll into Portugal and Spain if need be. But first,
Germany would do that. They're so angry.
And that's why it is such a challenge for them. But I do think that's the difficult thing, but it's what they have to do. We just faced it in the U.S. We've made those tough choices, the difference being we did it with one government body. Europe has to do it with several.
Adam Shapiro, what do you think?
Well, what about Italy? No one's talking about Italy, and there have been some guests on our programming who've said 6 months from now we are just back where we started. There are also stories coming out that it's not a $60 billion bailout to save just Greece. It's $130 billion that's really needed to tide this over. So this is not only difficult, it could actually be impossible.
Leave the EU, return to the drachma, start printing money, and this problem is solved, right? No way, right? Closing bell ringing in 20...